Hi everyone, and thanks for tuning in to another episode of Budget Investing. Today, I have two things that I'd like to go over with you. The first one is that I've added a new chart into what I'm tracking. This way I know I'm always maximizing the use of every single dollar. And secondly, I want to go over when should we be selling our stocks. So stay tuned for that, and I'll get into that here right away. Okay, so here's the chart that I mentioned. This is what's allowing me to understand where my money's sitting and making sure that I'm using it to its most efficiency at this time. I just want to break it down for you. So I have a few stocks that don't produce any dividend for me at all, and it's only about 1.8% of my portfolio. And I'll be honest, this is just a couple of ETFs, so that's fine. The next thing that I have are companies that are low yield. So their dividends that they pay are fairly low versus what they're costing right now. But you'll see in this particular category, most of them are high growth. So they're growing their dividends or even their capital appreciation by more than 10% every single year, which is fantastic for myself as I'm going to be in the economy for a really long time as I'm still quite young. So this is about 41% of my total portfolio. So that means in my opinion, I'm using my money very well. From there, companies that are medium yield. So this is companies that make a little over 2% but under 4% of a yield on their cost. These are a little bit more split down the middle. I've got a few that are growing but slowly. I've got a couple that are in the medium growth, which is greater than 6% but less than 10%. And then I only have a handful of them in the high growth, so it's greater than 10%. And this is equal to about 24% of my entire portfolio. The last section I have is the high yield, and so this is anything that pays over a 4% dividend. And these ones I want to try and eliminate as much as I can, as they are typically low growers. There's not many that would fit into the high growth section, and I'll be honest, this is just Enbridge. That's the only one that fits in the high growth, high yield, and that one's probably not going to grow very quickly outside of maybe its dividend in the long run. This is a great starting point for myself, as I know that 50% of my portfolio is what I would categorize as high growth. I'd have 22% into that medium growth and 25% into the low growth. So this just gives me an understanding of where my money's sitting. And for myself, I know that I want to put more money into the high growth area, as I want my money to be working really hard for me. So I want a little bit less into that low growth. So I'm just going to be making sure that I'm paying attention as to where my money's going from this point forward. All right, so when should I be selling my stocks in the stock market? This is kind of a difficult question, as each company will have a different reason why you should sell them. Truthfully, the way I would look at it is you should understand why you initially bought that company, what's your thesis behind it, and then what's changed. Why are you no longer interested in that company anymore? I'll give you a few examples today as to why I have changed my mind on a company, or why I may have been thinking about changing my mind. And I apply this to every single company that I hold, and it changes every single quarter as I review my entire portfolio every quarter, just to understand what's been going on in the economy. The first one that I'll use here is IBM. So recently, I have changed my mind on my stance with IBM. I initially bought them thinking that, hey, this was going to be a fantastic investment. And as I've reviewed it quarter over quarter, I've noticed a little bit of a trend. So the first one being that this company is honestly not really growing anymore. It's been pretty flat. As you can see on the chart here, for the last 10 years, it's been actually going down instead of up. And that's been a continuous trend. The next thing that I've noticed with IBM is that, of course, it's in the technology sector, and there's a lot of really rapidly growing companies that are out there right now that I feel my money is better used with those companies. I want my money to be growing, so I don't want it to be in a company that's not still aggressively trying to grow, or that's being able to benefit me in the short or long term. The next company would be SAGA MI. This is just an insurance company in Canada, and I initially bought them at the bottom of the COVID crash, so I just was holding on to it as a recovery play, as I knew people were going to need home insurance in the long run. You'll notice here that there was this huge uptick in the value of this company. Now this is when they did their quarterly earnings. Since then, they've been pretty flat. They've gone up a little bit, but they haven't really gone up a lot since then. Now, I bought this company again as a COVID recovery play. It had its huge uptick as things kind of reopened and everything got moving again. So I sold out of it. I took my profits for that time and I was happy. So that was my plan going into it, was that I was not planning to hold it long term. It is still a dividend aristocrat. It was paying a great dividend. So if I had to hold on to it for a while, it would have been fine, as I knew it would have recovered in the long run. So I had an exit strategy planned in my portfolio for this company. So now I come to Enbridge. Now this is kind of an interesting company for a lot of people, as they're a fantastic dividend payer. They pay a lot of money just for holding their stock. In the long term, they have been a really big growth company, as they provided a lot of capital appreciation for people, as the oil sector has been so profitable over the last 20, 30, even 40 years. And they're really positioning themselves to pivot into that renewable sector. So they're looking at really capitalizing on any potential money that could be in there. But as of today, are on the oil and gas sector still, so they're not really renewable companies. What would my exit strategy be for this company? So for myself, I don't want to hold them in the regards to oil and gas, as I think that is a dying area. So I would be hesitant to watch them slowly go down over time if they're not able to make that transition. The second thing that would make me potentially not hold on to Enbridge in the long term would be their dividend. So as I mentioned earlier, they are a fantastic dividend paying company. They've been growing it year after year for a really long time, and they pay a huge amount of money. Now that growth has been fantastic as the company's been growing with it, but now recently, as I mentioned, oil and gas is slowing down and people are switching into other forms of energy. So I would just be hesitant. I'm going to keep a close eye on Enbridge, as right now it's a great income company for me with the potential to make me money in capital appreciation. But if they were to cut their dividend significantly, or they make a huge blunder and they have a really severe decrease in their value, I might end up selling out of them. So just to recap, what I went over again today was really the exit strategy that you should have for each company will be different simply based on why you bought it. So if you're buying a company that was for the income of its dividend and it makes a huge cut, you probably don't want to be holding on to that any longer, as it's not going to be benefiting you in the way that you initially wanted it to. Other companies you may want to move around because they're underperforming in comparison to their sector, and you think that you'll have an opportunity to grow your money better somewhere else. There's no perfect answer as to why you should exit a particular strategy. If you're holding a company for its growth and maybe it makes you 30% on your initial investment and you sell out of it, yes, you may miss out on some of the potential upside that could come down the road. But if you were happy with the profits that you made, that's fantastic. You should do that. You don't want to miss out on all of that potential growth that you've already had by being greedy and staying in too long. Now, I hope you enjoyed today's video and found it insightful and gave you a better understanding of when you should potentially be looking at selling your companies, and understanding that you should always have an exit strategy for each stock that you do hold. If you'd like to learn more about this, please don't forget to subscribe and thumbs up the video, and I will continue to share my thoughts and opinions on what's going on in the economy from here. Thanks so much, and I will see you in the next video.